Hello, everyone. Welcome to day 3 of the Legacy Academy Bootcamp, right? And today we'll finally dive into trading. We'll dive into the chart, we'll explain who are the market participants, we'll explain everything about why are these candles moving up and down and nobody seems to understand what the F is happening, right? So no, I won't talk about indicators. I won't talk about how to actually trade, but I'll talk about how to make sure that you understand the basis of what you're dealing with. Okay? So we all know now that as a trader, you do have a role within the market, and your role is to make money out of money. How you do that, you're an intermediary between buyers and sellers, people who want to buy that asset and people who want to sell it. You're just here to hold a certain asset and sell it back, or borrow it and sell it and make a profit out of that. And I'm going to explain all that during this video, right? Okay, so here I'm showing you a chart. I'm even gonna remove this moving average. I'm gonna remove everything, right? I'm gonna remove all the things I have here that are drawn. Delete indicator. Okay, because I want you to see a chart naked. I want you to be able to look at a chart naked, without indicators, without help, without anything, and be able to understand what's happening. So right now we are on Euro USD, and we are looking at the 15 minutes Euro USD chart, right? You can look at the 30 minutes, you can look at the 1 hour, the 4 hours. It doesn't matter what time frame you're in, because all that knowledge still applies. So let's go on the 15 minutes, just for the, randomly. Doesn't really have a reason, but no matter what time frame you're at, you're going to read the chart the same way. You're going to understand the price movement the same way. And what you want to understand is that these fluctuations have a reason. It's not random. And some people are making the price move. So the market participants, for the sake of simplicity, people will tell you, okay, there are buyers that push the price up and there are sellers that push the price down. What you want to understand is that it's more complicated than that, way more complicated. You have market makers, you have dealers, you have retail traders, you have institutional traders with two different budgets, and you have a lot other participants that might actually use that asset. For example, traders globally, physical traders, commodity traders that might need Euro or USD in that case, that are actually interested in that price fluctuation. To be honest, as a trader, don't give a shit about the price fluctuation. What you want to do is make money out of the value that will be coming in the future, that you speculate about, right? So when you see an asset that you don't need, that you'll never use, and you see the price fluctuating, what you want to have a forward-looking view of how you can make money out of that fluctuation. So, for example, if you are on gold and you see the price going up, and you expect the price to go up, so you buy gold, you hold gold, and you sell gold. You'll never have the physical gold, but you're buying and selling a contract of the value of gold, basically. Euro USD is the same. Stocks are a bit different, but it's the same thought process. Okay? So for example, if you have a gold trader, somebody, not a gold trader like you, but a gold trader that is actually buying and selling physical gold, or businesses that are using gold to make jewelry, or businesses that are using gold in other ways, or businesses that are, mining gold and selling it, these people will make the price fluctuate. And if there's more gold in the market or less gold in the market, you'll see the price fluctuating. Or if there's more demand or less demand, or if there's war and times of uncertainty, or if it's all shiny and everybody's happy, you'll see the price fluctuating. So all these things in the society and within the economy make the price fluctuate. So behind that chart, you have a whole theater of things happening and making that price move. So there's a lot of things that you have to combine and understand to be able to uh, speculate about the price in the future in a methodological and logical way. You need to be rational in your thought process. You can't just say, oh, I feel it's going to go up. You don't feel shit. Okay, you don't have to feel stuff. What you have to do is read the price rationally, understand what's happening in the economy, and be able to look forward to certain levels of the price that the price might or might not reach. And this is how you'll be able to manage your trade, take your trade, manage your risk, and make money, right? So for example, if I have a chart like this, and I'm on the 4 hours, okay? And I look at this chart and I understand that Euro USD is one of the most traded pairs in the market. And there's a lot of people using Euro USD, and these people have different needs and very specific and particular needs for Euro USD. You might have people in the US and people in Europe that are trading merchandise, products, and services together that will have to look at Euro USD values and see who is taking more value in that transaction. Or you might have market makers that need to provide liquidity to the market, or you'll have traders that will take liquidity from the market because they'll place market orders, some of them, or you'll have dealers that will make money out of transactions traders make within their platform or with them. You have a lot of market participants, and there's a lot going on, specifically if we talk about the forex market. A lot, because you'll have central banks having policies making that price fluctuate. So let's say a good example, you got the dollar, and we're looking forward for the Fed to cut rates, meaning the interest rate of the dollar will go down. So investors that are currently investing in the dollar will have less value or less return on that investment on the dollar. So when the Fed will start cutting the rate, what's going to happen? Investors will start pulling back their money. They'll start removing their money from USD. On top of that, you got USD at one of its ever time low because it's getting weaker and weaker, and people are moving to other type of reserve or currencies. And then you got some other political and geopolitical things that are happening that we don't need to mention here, that might be too complicated at this point. But you understand that whatever you're trading, whether it's a stock, whether it's a crypto, whether it's forex, whether it's options, look, whatever you're trading, you're always trading a product. So let's say it's an intangible product. You cannot touch it, you cannot see it, you can only see its price, but you recognize that you are trading a product. You're not trading air, you're trading a product. And that product has a price. Now, that price might go up or might go down. So let's say you go somewhere and you need to buy clothes. And you want to buy, let's say you want to buy a t-shirt. And in the other store, there's another type of t-shirt. So you have like two choices. And you're asking yourself, why in store A, the t-shirt is $20 and why in store B the t-shirt is $100. Let's say you go and you ask the vendor in store A, well, the t-shirt, yeah, it's $20, but in the other store the t-shirt is 100. So he's probably going to tell you, oh, the t-shirt in store B is limited edition. It's another type of t-shirt because you got a logo in it. But you look at it and you look at the other t-shirt and it's exactly the same t-shirt and just the logo is changing. Guess what? Scarcity, for example, makes the price go up because there is less offer than demand. So let's say there's a lot of demand of USD and that demand is so high that it goes beyond what is offered. People want it. People want USD. Let's start buying and buying and buying and buying. Guess what's going to happen? You'll see the pair Euro USD go down because USD will increase in value. And when it's going to increase in value more than Euro, then you'll see the chart going down. And if it's the opposite, you'll see the opposite happening. So it's all a dynamic of supply and demand. It's offer and demand. So whatever is supplied to the market, if it's higher than the demand, the price will have to go down to attract more demand and to interest people, right? And you can exactly see that through candlesticks, which are just a reflection of what's going on in the market. It's just a reflection of the price, okay? It's a way of drawing the price action. And then if you got the demand increasing way more than the supply, then what's going to happen? The price will go up because people want to buy it. A lot of people want to buy it. So the people who supply that asset will increase the price because there's not a lot. They will be able to increase the price. Okay? The same thing is happening here. Let's say this is not Euro USD. Let's say this is banana, right? So let's say we're trading bananas, okay? Because, you know, it's a nice fruit. We're trading bananas and we see the price of bananas going up and down and we don't really understand what's going on. So let's say you see the price of bananas going down here, okay, on the 4-hour time frame. You see the price of bananas going down here, and you're asking yourself why the price of bananas is going down. Okay? So, let's say bananas this year, the supply was so high that it was too much supply for the market compared to the demand, because it's always compared to something. And you see the price going down. So no particular reason, the price is just going down because people might be less interested by bananas at this time of the year. And then you see this big movement happening. Why? Because an announcement of the banana industry is saying that, hey, next year there will be no bananas. So everybody's rushing to buy bananas because next year will be no bananas. We don't want to stay a whole year without bananas, so we want to go and buy bananas. And then you see the price rising. Why? Because now you have more demand. However, see that level? That's an important level right here, as you can see here. Why is it important? Because this is probably the highest point that the banana price reached before going down. Then people said, then the federal industry of the banana industry said, hey, no bananas now. So you'll see people rushing to buy bananas and the demand increasing, which is simple, right? Okay, they reach a price and people will be like, hey, that's way too high for a price. You know what? Well, we don't even care if there's bananas or no bananas at this price because well, bananas at this price is way too high. And then you see the price crashing because people are realizing that, hey, this price is too high. So probably this was a consensus price because a lot of people were buying at this point or at this point. And then the market had to find a price that would be good for sellers and for buyers. Okay, for the supplier and for the people who demand that asset. So it needed some fluctuation, and that happened. People stopped buying bananas, the price crashed down, they started buying back because it was at a discount, the price went up, and let's say that this line here, this price range here, that is the consensus price. That is the price that people accepted, sellers and buyers accepted to exchange bananas at this price. And all you have to do now is rewind that whole explanation and do it with Euro USD. Of course, it won't be that straightforward and simple for the simple reason that it's really easy to do it in hindsight. It's a bit more complicated if you have to do it in a forward-looking way when you don't know what's going to happen next. But you do kind of know what's going to happen next. So when we talk about speculation in the market, it's not complete speculation. It's never completely a speculation. What it is you're trying to have a forward-looking view on what's going to happen next in the price. So let's say, for example, you reach a consensus price here and you see the price, you see that this price interests people. So the lowest price of this range of prices where people actually like this price, both buyers and sellers and people are exchanging within this price range, whatever asset it is, whatever thing you're trading, product, service, stock, anything, okay? People are happy here. However, if you see something like the price crashes down and go way beyond the low, way below the low of that price range, and you're asking yourself, what's happening with the price of that asset? Why did the price did that? It will always have a reason. It will always have a reason. But you need to find what reason it is. Because it might just be a slip of price. And I'm going to explain why does that happen now. It might just be the price slipping and coming back up. Then this just act as if it never existed. However, if this actually has purpose and the price is actually crashing, you will have to find the reason. The reason might be anything. The reason might be that this asset, let's say, well, people don't want it anymore. There's something else that they want that is similar to this asset, but this asset is no use anymore. It's too old, for example. And this happened with a lot of companies, like, Blockbuster vs Netflix back in the days, went to zero. So yes, it's very important to understand what's going on in the market, to understand what will be going on with with the price of your asset. Now, explaining why the price might or might not slip and why sometimes the price dynamic or the price movement has no reason. There is a reason, but you'll never find that reason if you don't know what's going on. So right now, on top of that, you want to understand that the market is continuously changing. Let's say you have an edge in the market and you always trade that edge. An edge, for people who don't know, simply means you got a price structure that you recognize that is frequently happening and that is making you know as a pattern, or because you know how to read the price, is telling you where the price is heading, and so you're used to make money out of that particular structure. But the more people will use that structure and will see what you see and will trade and make profit out of it, the more that structure will disappear and the price dynamic will change, and you'll start losing money by trying to make money out of that structure and not understanding what's happening. Because more people take an edge and take advantage of an edge, the more that edge disappears and the market dynamic changes. Now, the market is even changing even faster for the simple reason that now you have high frequency trading. So back in the days, it was on the tapes. Back in the days, you had to go to the bank to say, hey, I want to trade this. You had to go to the floor and scream, I want to trade that. Today, everybody can trade. On top of that, you have new technologies. You have algorithmic trading that you didn't have back in the days, but today you have algorithmic trading, and high frequency trading is a subtopic, or is just a subsection of algorithmic trading, and it's taking advantage of micro movements in the market. And now, because everything is automated, it's very, very hard for retail traders to beat anything like a machine. Impossible. Don't even think about it. But it is possible to make money out of the market. And this is risk management and application of the right strategy that we'll talk about and work on throughout this bootcamp. But right now, my objective was simply to tell you, hey, when you look at a chart, it's not simply fluctuations. It is price fluctuations that have a reason. And the chart is not simply a chart. It's a representation of what's going on in the market. And there's a whole theater. The whole world is working on that. The whole world is making that price fluctuation happen because it's a complete dynamic, a puzzle, a complete story that is making that story displayed through charts by simply representing through candlestick what is the price doing. Once you understand that, that's the basis of what you're going to deal with. You're going to deal with the price of an asset. You're going to deal with classical economy, knowing that classical economy tells you that, hey, the market is efficient, the market is not efficient. But this is why you can make money out of the market. Because the market is inefficient, this is how we as traders make money. If the market was efficient, you would have a straight line, no money. But because you have fluctuations, because you have volatility and you need volatility as a trader, because you'll have an edge and you'll understand what the market is going to do, you'll understand what the market is doing, why it's doing it, what purpose has it, what is making the price fluctuate, and you have a lot of tools to do that. But you don't want to rely on them. You want to understand the price dynamic first. You want to understand what's going on in the market. When I open the news and I see Trump saying, hey, I'm going to take Bitcoin as the new Federal Reserve. No more gold, Bitcoin. What are the people going to do? They're all going to buy Bitcoin. They're all going to sell gold. If gold is just dumped, of course, gold is not going to be dumped. But okay, now we're going to keep gold and we're going to add Bitcoin to the reserve. What's going to happen? Gold is going to stay the same. Bitcoin is going to rise in value. And it did. It did. It breached the 100K. It did. Once you understand that dynamic, and it's not that complicated, you just need to realize it and to work on it. And more you're going to practice it and practice it and practice it and read it and observe and apply the strategy that you built and apply the risk management in a consistent way, then you'll be able to make money out of that. Now we'll go through all the details because we still have, this is the third day, we still have 27 days of bootcamp. And I want to go through all the details, okay? So I'll see you tomorrow. We'll go into and dive into that information and all the information we see within the charts. What are the market participants actually doing? How can you now actually trade and understand the price movement, and we'll talk about areas of interest. We'll talk about what price you can trade from, what price you cannot trade from. We'll talk about where to put stop loss, where to put take profit, and why. We'll talk about different types of trading, day trading, swing trading. We'll talk about investments as well, because that's also an important topic. And as long as you are a trader, you can be an investor. And it's not because you're an investor that you can be a trader. Well, that's different. We'll talk about how to manage a trade, how to manage your capital, and how to manage your trading journey to avoid as much as possible your downside, to reduce it as much as possible. And that's simply the effect of it. When you reduce your downside, you increase your upside automatically, and your profits just keep growing and compound and compound and compound until you'll see that in no time, hey, things are happening, right? So I'll see you tomorrow, excited as hell, and then we'll make that happen.